Okay, good afternoon, everyone. Welcome to day 17 of this workshop, Strategic Virtual Financial Reporting Program for professionals in field of accountancy and finance. And today is Sunday, the 14th of March, 2021. Okay, yesterday we introduced ourselves to group adjustments and we started with adjustment regarding unrealized profit on sale of goods. And the first one we looked at yesterday was a situation where the sales was initiated by the parent and the purchases was done by the subsidiary. And in such a transaction, we say is a downstream transaction as it originated from the parent to the subsidiary. And in that case, we look at unrealized profit adjustment, where we discover that such an adjustment will be to affect the profit of the parent, which is the seller, and to affect the value of the inventory of the buyer, which is the subsidiary. And we went on to consolidate. Now, today we are looking at upstream transaction. What is an upstream transaction? This is a transaction where reverse is the case. The seller, in this case, is the subsidiary, while the buyer, in this case, is the parent. Therefore, what is the significance of that? Probably when we get to the bridge, we'll cross it. Okay. Before we cross the bridge, I want Shegun to read a little about upstream transactions, and we'll now use this illustration 2, which is exactly the same thing as illustration 1 to depict our understanding. The only difference is that they swap the parent for the subsidiary as the seller of the goods. Let me try and enlarge it for you so that you can be able to read for us. Over to you.
Okay, upstream transactions. This involves the sale of goods by investee, that is subsidiary, to the investor, the parent. Since the parent is recognized by the subsidiary upon sales to the parent, since the profit is recognized by the subsidiary upon sales to the parent, the unrealized profit should be adjusted partly against the consolidated retained earnings with respect to those attributable to the parent, and partly against non-controlling interest with respect to those attributable to the parent, and where the subsidiary is partly owned by the parent's company. Accounting treatment and entries. Remove the whole profit loading and charge the non-controlling interest with their proportion preferred method. Debit consolidated retained earnings with the parent share of unrealized profits. Debit non-controlling interest with the NCI's share of unrealized profits. Credit group inventory statement of financial position with the total unrealized profit. Illustration 2. Pali PLC acquired 160 million of the shares of Suzy PLC when the reserves were 20 million naira. During the year to 31st December 2015, Suzy PLC sold goods costing 10 million naira at profit of 20% on the cost to Pali PLC. As at the reporting date, only 40% of these goods were sold to external customers by Pali. In the same period, the statement of financial position of the dual companies as at 31st December 2015 is as follows. Statement of financial position as at 31st December 2015. Pali PLC and Suzy PLC, and all figures are in million naira. Assets, non-current assets, property, plant and equipment, 110 for Pali, 120 for Suzy. Investment in Suzy PLC, 100 for Pali. Current assets, inventory is 40 for Pali and 45 for Suzy. Account receivables is 15 for Pali and 12 for Suzy. Bank is 5 for Pali and 7 for Suzy. Total assets is 270 for Pali and 184 for Suzy. Equity and liabilities. Equity ordinary shares at 50 kobo per share is 80 for Pali and 100 for Suzy. Retained earnings is 140 for Pali and 60 for Susie. Current liabilities is 50 for Pali and 24 for Susie. Total equity and liabilities is 270 for Pali and 184 for Susie.
Okay, thank you very much. Okay, you find out that the question is not different from what we did yesterday. Okay, the only difference which I'll emphasize in this color, therefore I'll change the emphasis of the color to, let me change it to orange. Okay, now you find here that they said Pali sold to Susie. Every other figure here is exactly the same thing with what we want to do now. But in this case, what do we see is that Susie sold to Pali. That's just the difference in the question. Will this bring about difference in our proposed solution? Let us see what happens. What I'll do is that I will copy our solution yesterday and I'll bring it forward to today. Okay. Okay, I've copied this. And you see where the difference lies. Okay. Now, everything remains the same with our structure. Everything remains the same with our structure. And Susie Reserve is broken down into pre and post-acquisition. It remains the same. And our analysis here remains what? The same. Only that what? Only that here, we no longer assume that the parent sold. And we no longer assume that the subsidiary purchased. And it's no longer a downstream transaction. What then is it? It is subsidiary that sold to the parent. And in such a case, we say is what? An upstream transaction. Now, if it's an upstream transaction, who initially made this profit of 2 million? Let me highlight it. Who made this 2 million naira profit? It is the seller. Who is the seller in this case? It's the subsidiary. Now, if the seller made this profit, and we all agree that 60% of it, which accrued to 1.2 million, is unrealized, it means such a profit had to be reversed from the books of the seller. And if the profit is reversed from the book of the seller, what then happens is that instead of the parent, in this case, it will be the subsidiary. Therefore, I come here to say, is the subsidiary that is the seller who we are going to adjust the profit against. Now, but the subsidiary profit will reduce by 1.2 million. Invariably, who will be affected by the reduction of 1.2 million naira in the subsidiary's profit? It is nobody other than the shareholders of the subsidiary. And who are the shareholders of the subsidiary, if you could recall? The shareholders of the subsidiary, in this case, are PALI
And ACI.
and NCI. Which that means invariably they will suffer that defect or that reversal of profit or reduction in profit in the ratio they share profit or loss, which in this case is 80% and 20%. Therefore, what happens? It then means that this subsidiary profit that we are adjusting for will eventually affect the parent and NCI. And therefore, what will I do? Let me clean this up. It means the debit, invariably, this debit means debit 80% of it to the parent through the consolidated what? Reserve. And 80% of 1.2 million. The second debit is debit 20% portion to NCI. Therefore, 80% of 1.2 is what? And 20% of 1.2 is how much? The whole of the credits goes to the buyer's inventory, which is the parent, which will eventually still be consolidated with that of the subsidiary. Okay, who will give me 80% of 1.2 and 20%?
80% is 0.96.
That's 960,000. 4.96 million.
Yes.
And this should be 0.24 million. Now, that is just the difference in the question. Now, if you compare this, what we did here was subsidiary, who is the seller? But in the first one, that was for yesterday, What we did here was parent, the seller, and here, subsidiary, the buyer for inventory. But here, is a parent that is a buyer, which means reverse is the case. Okay, now how does that affect our goodwill? It has no effect on goodwill because these are post-acquisition transactions. Therefore, goodwill remains the same. But what effect does it have on our consolidated retained earnings? Is the fact that instead of adjusting it only on the parents, the 1.2 has been shared between the parent and the NCI. Therefore, I come here to recognize that fact and say the adjustment will be 0.96 for the parent and 0.24 for the subsidiary. All in all, what do we have? 140 plus 32 minus 0.96. That is 171.04. 28 plus 8 minus 0.24. That's 35.76. Therefore, what do we do?
Supposed to be 31.76.
Is it 31.76? I'll check. I'll check. Probably my calculator is deceiving me here.
It's 31.76.
Okay. 24 plus 8 minus 0.24. Okay, 31.76. What's wrong with this? Let me reset the pen. Okay. Now, how does that affect our balance sheet? Our asset position remains the same with this 1.2, but our equity position will change because it's no longer 170.8. And this will change, and this is no longer 32. Therefore, what is it? 171.04 and 31.76. 171.04 and 31.76. This should give us what? 251.04. And this should still give us the same figure, which means it's just a distribution between consolidated retained earnings and the amount of what? NCI. All other things remain what? The same. Any question? Which means the difference between upstream transaction and downstream is that upstream is a transaction done by the subsidiary, while downstream is a transaction initiated by the parent. When you are to reverse the profit for a downstream, which is that of the parent, NCI is not affected because NCI is not a party to the parent's activities. But anytime there's a transaction regarding the subsidiary which affects its profit with respect to downstream upstream transaction, NCI is affected in the proportion NCI will have participated in the profit or loss of that subsidiary. Any other question? Any other question? Okay, now let's move to the next transaction. The next transaction deals with unrealized profit on sale or transfer of assets. Now, there are two adjustments required when there's a transfer, of assets within the group. And they include: one, adjustment for unrealized profits, and two, adjustments for depreciation if it's PPE, or amortization if it's intangible assets. But this adjustment is only required for assets with definite life. Who can tell me why or what that means? What it means is this: if the asset to transfer is not depreciable, and it's not depreciable because it has an indefinite life, such as land, the second adjustment will not be required because that asset has not been depreciated such that you need to make an adjustment to the depreciation amount. But if it's an asset that is subjected to depreciation, because of the differences in the value that the asset was transferred for and what it was carried for initially by the former owner, it will automatically affect the amount of depreciation which you need to adjust for. Now, what are we saying here? If a subsidiary transfers its asset to the parent or vice versa, and the transfer was done at the carrying amount, therefore, there won't be issue. But you know, the reality is that that will not be possible because of transfer pricing that requires unclaimed transaction, and because of there more or less different composition of shareholders in both companies. Therefore, each entity is seen as separate from the other, and they are expected to conduct transactions at arm's length. The arm's length means that if you are to sell such an asset to a third party, will you sell it at your book value? 99% of the time, the answer will be no. You will sell it at a price, which is more of a reflection of what the market is willing to pay for. Which then means that it is more likely that you'll have sold that asset or transferred that asset at a profit if it is actually done at arm's length. In that regard, what you have simply done is that because of the transaction within two of you, parent and subsidiary, the asset of the group will have been overstated because of the profits that is embedded in the sales. Now, let me give you a practical example. Last year, the same asset was in the parent's book. By the time you consolidate it, it gives us 100. Now, but because this year, the parent has sold it at 120, let's say it's a land. In the books of the subsidiary, the same thing that was 100 last year is now showing 120 in the books of subsidiary. Upon consolidation, the group balance sheet looks big than last year. But the question is, what has made it big is just crossing of transaction between the parent and the subsidiary, which does not reflect the economic substance of the transaction based on the fact that from the group perspective, both parties are seen as one. Therefore, what do? Is for us to eliminate such unrealized profit. But because it is a land, there's no worry for depreciation and there's no adjustment. But if it has been property, like the building, like motor vehicle, it then means that the new buyer would have depreciated it at the 120 price he bought it, being its own cost. And that would have made the depreciation higher than what it would have been if you have recognized at 100. And since we have deemed it fit to reverse the profit at the group level upon consolidation, every year, the impact of the depreciation based on the transfer price must also be eliminated, the same way we eliminated the profit. And that is what gave birth to the second adjustment. But the second adjustment is only required where such an asset transferred are depreciable assets, are assets that are either subjected to depreciation or subjected to any basis of cost allocation, such as amortization. Now, to do that, to continue in that trajectory, we are going to look at a practical illustration from our text. Okay, I'll cut this off. I'll put it on my whiteboard. Okay. I want somebody to read this question. I want somebody to read this question. Madam Grace, are you there? Okay, I can't see. Madam Grace, can you help us with this question? Can you unmute your unmute?
My voice is not that clear.
Yeah, but we'll manage.
All right. Illustration 3. Pali PLC acquired 160 million of the shares of Suzy PLC since the incorporation of that company. Pali PLC transferred plant to Suzy PLC for 40 million naira and has a carrying value of 36 million as at the transfer date, 1st January 2014. The group has a uniform depreciation method for the same class of asset, which is a straight line method. As at the transfer date, the remaining useful life of the plant is 10 years. The statements of financial position of the dual companies as at 31st December 2015 were as follows. Statements of financial position as at December 2015, Pali PLC and Suzy PLC in millions of naira. Assets, non-current assets, property, plant, and equipment. For Pali, it's 110 million. For Suzy, 120 million. Investment in Suzy PLC, 100 million. Current assets, inventories, 40 million for Pali, 45 million for Suzy. Accounts receivable, 15 million for Pali, 12 million for Suzy. Bank, 5 million for Pali, 7 million for Suzy. Total assets, 270 million for Suzy, 184 million for, 270 million for Pali, 184 million for Suzy. Equities and liabilities. Equity, ordinary shares of 50 naira per share. For Pali is 80 million naira and 100 million naira for Suzy. Retained earnings, 140 million naira for Pali and 60 million for Suzy. Current liabilities, total current liabilities, 50 million for Pali and 24 million for Suzy. Total equity and liabilities, 270 million for Pali, 184 million.
Okay, thank you very much. Now, the structure. What is our percentage holdings? You acquire 160 million. Out of how many shares? We don't know, but this is share capital. The number of Suzy's shares will now be the 100 million divided by what? 50 kobo a share. That gives us what? 200 million what?
200 shares.
That is 160 out of 200 million shares will give us 80%. Therefore, I can come here to say this is 80% and this is what? 20%. Date of acquisition was since incorporation. That means we don't know when, but since what? Incorporation. And we are reporting today, 31st December 2015. Okay, now, the reserve of Suzy as of today is how much? Is 60. And this 60 have to be split into pre-acquisition, which was since incorporation, and post-what? Acquisition profit, which is the balancing what? This is plus 60. Now, from the information we have here, what is our pre-acquisition profit? What's our pre-acquisition profit? Who can answer that? What's our pre-acquisition profit? Who can answer that? No time to waste. Who can answer that?
I think since it's not mentioned in the question, because I can't see anywhere they mention pre-acquisition profits.
Okay.
And looking at the date of consolidation must be different from the date of acquisition, because the asset was transferred on 1st January 2014, and we are consolidating until 1st December 2015. It's more likely that the pre-acquisition profits could be zero.
Okay. What does this statement stand for? You acquired the company since what? The incorporation. What does it stand for?
That means okay, so
yeah?
That means it was acquired when the company started business and it hasn't made any profits.
Okay, not when it started business, when the company is yet to commence business, which means it's just a registered company that somebody decided to acquire certain shares of it. Have you?
Yes.
Now, what does that signify? Have you ever seen a business that is incorporated with profit at the start of that business? It's a question.
No, sir.
Yes. At incorporation, you are at ground zero, no profit, no loss, because you are just starting up a business. Therefore, what they want to test is your understanding here to say, this is what? This is zero, which means all of the profits are what? Post-acquisition. Now, but that's not our concern. What is our concern? Our concern is that there is a downstream transaction that entails the parents to have sold plants to who? To Susie. He sold the plant for how much? 40 million. When the carrying amount of the plant was what? 36 million. It means he made profit of 4 million on disposal of assets. But unfortunately, it disposed to a member of the group, which means though in its individual financial statement, it is realized profit, but from the group perspective, such a profit is deemed what? Unrealized. Therefore, what you need to do is to reverse such a profit. Now, we come down. Elimination of unrealized profits on sale of plants. What is the unrealized profit? The unrealized profit is the difference between the transfer price or the disposal value, which was 40 million, and the carrying amount, which is also known as a book value of 36. This profit is unrealized on disposal of assets. Now, this profit is made by who? It's made by the seller. The seller in this case is who? The parent. The buyer in this case is who? The subsidiary. Hence, this form, this is what we mean by a downstream. This form will be adjusted against the profit of the parent, who is the seller. By doing what? By recognizing these entries. Debit, the consolidated retained what? Earnings, which is for the parent. And credit, the subsidiaries plant, which is a component of PPE. With how much? With the 4 million naira. But the adjustment only addresses this. The next one is the second adjustment, which means if you go by the books of the subsidiary will have been depreciating on the basis of 40 and not on the basis of what? 36. And what that signifies that the depreciation recognized by the subsidiary will be higher than what it should have been. Therefore, what do you have to do? You have to reverse it. Adjustments. For excess, or what some people call over depreciation of assets. Remember, this adjustment will not be required if it's land because there was no depreciation in the first place. Therefore, nothing to adjust for. Now, there are two approaches to which I'll do this adjustment. Approach A says that, okay, what is the depreciation based on the transfer price? And let me compare it with the depreciation based on the carrying amount. If you are to depreciate an asset, you bought it for 40 million. And as at the time you bought it, we were told that as at the transfer date, when you bought, they were told that the remaining useful life of the plant is 10 years, which means your average depreciation, given that the depreciation method is straight line, would be to divide 40 million by what? 10 years. That gives approximately 4 million depreciation per year for the next 10 years. But if you go back, how many years has gone between the day the transfer was made and today, that is the reporting what? Date. Which is this date. How many years has passed? 2 years. Which means depreciation of 2 years will have been charged. 4 million per year for 2 years will give us what? 8 million. But what we are saying is that if you know that you are truly a member of a group, as a group, you shouldn't have transferred above 36 million, which was the book value. And if you have done it at 36 million, and the same 10 years is required, it means your depreciation will have been 3.6 million per year, not 4 million. And in 2 years, it will have been 7.2, which means you have over depreciated in 2 years by 800,000, which is a 400,000 in year 1 and 400,000 in year 2. 400,000 being the difference between 4 million annual depreciation and 3.6 million. And that is what we mean. And this also is supported by approach 2. To say approach 2 is saying that your adjustment for a 2-year depreciation is to say, look at what are the common factors. 10 years is a common factor. 2 years consumed is a common factor. What is not common are these items, 40 million and what? 36. And the difference between them is what is causing these differences here. Therefore, what do? The common factor is to say 2 years is the year we are trying to adjust for out of the entire 10 years, multiplied by the difference between this 40 million and this 36 million, which is the 4 million unrealized profits. Therefore, I'll say 2 over 10 years times what? 4 million. That will still give me 0.8, which means regardless of how I do it, I'll still get the same what? Answer. Now the question is this. The subsidiary has charged 8 to its profit instead of what? 7.2. The question is, that will have understated the profit of the subsidiary because of you have overcharged and extras. Now that we have discovered that, what do? We reverse that excess of 800,000 in order to restore the profit of the subsidiary by increasing the profit by 800,000. And invariably doing so is that NCI and the parents will rejoice because it's like we are dashing them more money to share. In what ratio? 80-20. Therefore, it means to restore the asset value, you debit the subsidiary's plant, which is PPE, with the 800,000. And you credit the subsidiaries' profits, which invariably 80% of it goes to the parent. 20% of it goes to the what? NCI. 80% of 800,000 should be 640,000 which is 0.64 million. 20% of 800,000 should be 0.16 million, which is 160,000. And that's what we are talking about. Any question? Any question here? If there's no question, therefore, what happens to our goodwill?
Mr. Muyiwa, sorry, there is question.
Yeah, what's it?
Actually, I just want to reshape my understanding, because like the first one we treated that has to do with sales of goods. When we treated downstream transaction, I think it affected only the parents.
Yes, which is what we did here.
Okay.
Unrealized profit, only the parents.
For the, yes.
Mm-hmm. Why did it affect only the parent? Can you explain?
Because parents is the one that sold to the subsidiary.
And it's one that has made that profit, which we have found out that is not realized.
Exactly.
Yeah. Now, who has depreciated an asset? Is it the parent or the buyer?
It is the buyer.
Whose profit has been affected by charging on depreciation?
Is the buyer.
And who is the buyer?
Subsidiary. Yeah.
Therefore.
Okay, I get it now. I get it now.
Okay. Now, what is our cost of business combination? Pali's investments. The what? In Suzy. How much was it? 100. NCI is measured at proportionate share. We'll come back to that. And we measure the net asset as fair value as at the acquisition what? Date. Share capital. And pre-acquisition reserves. What is share capital? 100. What is pre-acquisition reserve? 0. If I come here, I say 100 and what? 0. That gives me what? 100. Which means NCI is 20% of 100, which is 20. And that gives me what? 120. All things being equal, there is a goodwill of what? 20. Consolidated reserve. And what? NCI as at today. Pali's reserve. $140. Sorry, why am I putting it there? NCI as at acquisition date. That's 20. Share of post-acquisition profits. What's the post-acquisition profit? 60, positive 60. Ratio 80, 20. That is 48 and 12. And we have adjustments. The first adjustment is to charge the whole of this formula on the parent. Which means deduct unrealized profits on disposal. How much? 4 million, the parent alone. Depreciation adjustments. We said increase the share of profit in subsidiary to the parent by how much? 640,000 and NCI 160,000. Add excess depreciation adjustment on plants 0.64 and 0.16. All things being what? Equal. What do you have? 140 plus 48 minus 4 plus 0.64. 184.64. 20 plus 12 plus 0.16. That's 32.16. Therefore, I can proceed to copy the balance sheet here. Okay, let me clean it up. Now, what is our PP? $110 and $120. But there's an adjustment to it. The first adjustment is for us to eliminate unrealized profits of 4 million. The second adjustment is to increase it by the amount of depreciation that was charged in what? In excess, which means minus 4 million plus 0.8. I thought I've written this before. This is 110 and 120. I guess I was correct. 110 and 120, yeah. Minus 4 plus 0.8. $110 plus 120 minus 4 plus 0.8. That is 22.6.8. What is our goodwill? 20. To 46.8. What's our inventory? 40, 45. What's our trade receivable? 15, 12. That's 27. What's our bank? 5, 7. That is 12. 85 plus 27 plus 12, 124. And 124 plus 246.8. That's 370.8. Share capital value. That's 80. Retained earnings. Our retained earnings is 184.64 and NCI 32.16, 184.64. $184.64 and 32.32. 32.16. $32.16. 80 plus 187, 184 264.64 is 264.64 plus 32.16. That is 296.8. What is our payable? $50 and $24. That's 74. 296.8 plus 74, that is 370.80, which is the same thing we have here. And that says it all. Any question? Any question? Any question? Any question? I wait you guys. Okay. Now, what will be the position if reverse is the case? What's the reverse as the case? The same question, but here, sorry. What would be the situation if reverse is the case? Which means who sold? It is Susie, the subsidiary that sold. It is now upstream. Okay. I want somebody to read this question, which is the same question, but you'll see the dynamics of it. Okay, Shagun.
Okay. Illustration 4. Pali PLC acquired 160 million of the shares of Suzy PLC since the incorporation of that company. Suzy PLC transferred plant to Pali PLC for 40 million naira and has a carrying value of 36 million naira as at the transfer date, 1st January 2014. The group has a uniform depreciation method for the same class of assets, which is a straight line method. As at the transfer date, the remaining useful life of the plant is 10 years. The statements of financial position of the dual companies as at 31st December 2015 were as follows. Statement of financial position as at 31st December 2015 for Pali PLC and Suzy PLC, and the figures are in million naira. Property, plant, and equipment 1110 for Pali and 120 for Suzy. Investment in Suzy PLC 100 for Pali. Inventory for Pali is 40 and 45 for Suzy. Account receivables is 15 for Pali and 12 for Suzy. Bank is 5 for Pali and 7 for Suzy. The total assets 270 for Pali and 184 for Suzy. Equity and liabilities. Ordinary share capital at 0.5 naira per share is 80 for Pali and 100 for Suzy. Retained earnings is 140 for Pali and 60 for Suzy. Current liabilities is 50 for Pali and 24 for Suzy. So total equity and liabilities 270 for Pali and 184 for Suzy.
Okay, the question remained the same. What is the area of difference? The area of difference is Suzy transferred to Pali. That's just the difference. Now, what impact does this have in our books? I'll copy our solution, this last solution. Okay. Okay. I'm trying to align it. Okay. I've realigned it. I've copied and realigned it. All information remain the same. Now let me now copy the question. Illustration 4. Okay. Remember 80% and 20%. Percentage holdings is 160 over the 200 million shares, which gives 80%. Our date of acquisition is since incorporation, and we are reporting 34 December 2015. Now, where is the difference? As I've said earlier, this is upstream. And why is it upstream? Because I came here the other time to highlight that Susie transferred to Pali. Now, in that light, where's the difference? The difference is who is the seller in this case. The seller has changed from the parent to the subsidiary. And the buyer has changed from subsidiary to the parent, which gives us an upstream transaction. Subsidiary is the seller. And the buyer is the parent, which is what? An upstream transaction. Now, which means the profit of the subsidiary has been overstated. And therefore, we need to reduce that profit by way of debits. The subsidiary with the seller's profit. I remember the profits of the subsidiary will eventually affect the parents. 80% parent portion, 20% NCI's portion, and the entire credits is a reduction in the parent's plant, which is an item of PPE. How much? The 4 million naira. This 4 million. Now, what is 80% of 4 million? What is 20% of 4 million? I need your calculators. %80 of 4 million, that's 3.2 million. And 20% is 0.8 million. Therefore, this 3.2 and 0.8 affects this entry. Instead of here that only 4 million was charged to the parent, now the 2 will be shared between the parent and NCI. Parent is 3.2, NCI is 0.8 that make up the 4 million. Now, who is carrying the assets is the parent, because the parent is the buyer. And whose profit has been understated by overcharging depreciation is the buyer, which is the parent. Therefore, this no longer applies. And if that is the case, NCI is not affected by what affects the parent's profits. Therefore, it is only the parent's profit that is what affected. No portion goes towards NCI. I come here. The parent's profits, which affect consolidated what? Reserve. How much? 800,000. Which means here, instead of affecting both parent and NCI, it only affects the parent. Therefore, our total figure changes because this 0.8 is only to increase the parent because it's the parent that has suffered excess depreciation. Therefore, what do we have? 140 plus 48 minus 3.2 plus 0.8. That gives me 185.6. 20 plus 12 minus 0.8. That gives me 31.2. Invariably, this is not affected, but what is affected is between the parents, retained earnings, which is consolidated, and the amount of what? NCI. Okay, what is the retained earnings? For the parent, 185.6, and NCI is what? 31.2. 185.6, 31.2. This is 265.6, and this remains 296.8. And the position remains what? The same. This is the adjustment regarding upstream or downstream transaction with respect to transfer of assets. Any question? Any question? Any question? Okay. Any question? I can't hear your voices.
Okay, as I'm concerned, I don't have any question. but rather I have clearer understanding of the treatment of this transfer of assets between the parents and subsidiary, unlike
Okay,
the sir.
thank you.
You're welcome.
Now, I want you to go and read more about, go to the text and read more about alternative way to which such adjustment was made. Okay, but the most appropriate way or the preferred methodology is what I presented. Okay, with respect to when is NCI affected in the whole process of making group adjustments. It's at the point where subsidiary is strictly affected, and that's the position that I've taken. Any other question?
Okay, mine is just coming as a contribution. Like with the way you've explained the whole thing, the accounting entries and treatment, we don't really need to cram them. Okay,
At all.
as long as you know who is buying, who is selling, whose account is affected, does it affect
Exactly.
both parent and NCI? Is it only the parent? So with that understanding, we can pass the entry easily.
That is how it's supposed to be. It is principle based, not cramming entry and not understanding why you are doing what you are doing. Okay. In the answer of no question, okay, I will give you the following task that will lead us to other adjustments. Other adjustments such as intercompany balances. Homework. Any other question before we call it a day? Any other question? Okay, in the absence of no question, I appreciate you for today. Thank you, and God bless.